Welcome back to the Crypto Intellect, the channel where we break down the biggest stories in crypto, blockchain, and digital finance in a way that actually makes sense. Today's story starts with a number that almost every crypto investor knows by heart: 21 million. For years, that number has been celebrated as Bitcoin's greatest strength. It's the foundation of the scarcity narrative. It's the reason so many people compare Bitcoin to digital gold. The promise is simple: there will never be more than 21 million Bitcoin. No central bank can print more. No government can inflate the supply. No corporation can change the rules overnight. That certainty created one of the most powerful investment stories in modern history. But what if the very thing people praise the most is also hiding a challenge that few investors are talking about? What if that famous number is not just a supply cap, but a countdown? Because once you start looking deeper into how Bitcoin's incentives work, a fascinating question begins to emerge. And according to many XRP supporters, it's a question that XRP solved before the network even launched. Before we go any further, I want to make something clear. Nothing in this video is financial advice. I'm not here to tell you what to buy, what to sell, or what asset will outperform another. My goal is simply to explore ideas, connect dots, and help make complicated topics easier to understand. The crypto market moves fast, emotions run high, and headlines often create more confusion than clarity. That's why it's important to slow down and look beneath the surface. Sometimes the most important developments are the ones nobody is paying attention to because everyone is focused on price action. The reality is that markets change, narratives evolve, and technologies mature over time. What seems obvious today can look completely different 5 years from now. So as always, take what is useful, leave what isn't. Do your own research, and make your own decisions. With that said, let's dive into one of the most interesting debates happening beneath the surface of the crypto industry right now. To understand this story, we need to go back to the beginning. Every blockchain network faces the same challenge when it launches. It doesn't matter how brilliant the technology is or how elegant the code may be. If nobody participates in securing the network, the system simply doesn't work. A blockchain without participants is like a city without residents. The infrastructure may exist, but there is nobody there to keep it alive. The question every project must answer is surprisingly simple. How do you convince people to dedicate resources to securing the network? Bitcoin solved this problem through mining. Participants contribute computing power, consume electricity, compete to validate transactions, and in return receive newly created Bitcoin as a reward. It was a revolutionary idea. The incentives worked perfectly. People around the world invested billions into hardware and energy infrastructure because there was a financial reward waiting at the end of the process. Bitcoin's growth was fueled by one of the most successful incentive systems ever created. But XRP approached the same problem from an entirely different angle. Instead of building a network dependent on mining rewards, the creators of the XRP Ledger chose a completely different architecture. There would be no mining, there would be no block rewards, there would be no endless creation of new coins to incentivize participation. At the time, that decision attracted enormous criticism. Many people argued that mining was essential to legitimacy. Others claimed that a system without mining was somehow less decentralized or less trustworthy. For years, critics pointed to this design choice as a weakness. It became one of the most common attacks against XRP. The argument was simple. Bitcoin miners earned their coins through work, while XRP entered circulation through distribution and sales. To many early crypto enthusiasts, that distinction mattered. It became part of the cultural divide between Bitcoin supporters and XRP supporters, a debate that has continued for more than a decade. Yet, when you step back and look at the bigger picture, something interesting emerges. Whether someone spends money on mining equipment and electricity or spends money directly purchasing an asset, value is still being exchanged. In both cases, resources go in and tokens come out. The difference is not necessarily about value creation. The difference is about incentives and sustainability. Bitcoin chose a model that continuously rewards network participants with newly created coins. XRP chose a model that removed that dependency from the beginning. For years, this distinction seemed largely philosophical. But as Bitcoin matures and moves closer to its ultimate supply cap, that difference starts becoming much more significant. What once looked like a minor design decision suddenly appears to have long-term consequences. And that's where the idea of the so-called 21 million trap begins to enter the conversation. The challenge becomes clearer when we examine how Bitcoin's reward structure actually works. Today, miners receive compensation through two primary sources. The first is transaction fees paid by users. The second is newly issued Bitcoin created with each block. Historically, the newly created Bitcoin has represented the majority of miner revenue. Every 4 years, however, the Bitcoin halving reduces those rewards by 50%. Over time, the amount of newly issued Bitcoin becomes smaller and smaller. Eventually, the final Bitcoin will be mined. At that point, there will be no more block rewards. The supply will have reached its maximum limit. From that day forward, miners will rely entirely on transaction fees. This has always been part of Bitcoin's design. It isn't a bug. It isn't a surprise. It is exactly how the system was intended to function. The question is whether transaction fees alone will be enough to maintain the same level of security and participation. That question becomes especially important when we consider the dominant Bitcoin narrative today. Millions of investors view Bitcoin as a long-term store of value. The message repeated across the industry is simple: buy Bitcoin, hold Bitcoin, and don't sell Bitcoin. Many people see it as digital gold rather than a transactional currency, and that narrative has been incredibly successful. But hidden inside that success is a potential tension. If everyone is holding rather than transacting, then transaction volume could remain relatively limited. If transaction activity remains limited, fee generation may also remain limited. And if fees are limited, then miners may eventually find themselves earning far less than they do today. Suddenly, the future economic model becomes less straightforward than it appears on the surface. The same behavior that strengthens Bitcoin's store of value narrative could potentially create challenges for the incentive system supporting the network decades from now. This is where the discussion becomes truly fascinating. Imagine a future where Bitcoin block rewards have disappeared. The miners responsible for securing the network still face real-world costs. They still pay for electricity. They still maintain infrastructure. They still invest in hardware. Those expenses do not disappear simply because the last Bitcoin has been mined. If transaction fees fail to generate sufficient revenue, miners could face difficult decisions. Some may choose to shut down operations. Others may seek alternative opportunities. We are already seeing hints of this dynamic today as certain mining companies explore artificial intelligence data centers and other revenue streams. The point is not that Bitcoin is doomed, far from it. The point is that incentives matter. Every network depends on incentives, and understanding how those incentives evolve over time is one of the most important questions investors can ask. Now imagine the perspective of Bitcoin holders. For many of them, the 21 million cap is sacred. It is the foundation of the entire investment thesis. The fixed supply is not merely a technical feature. It is the promise that differentiates Bitcoin from traditional monetary systems. If additional Bitcoin were ever created beyond that limit, many supporters would argue that the fundamental value proposition had been compromised. The scarcity narrative would change overnight. Confidence could be affected. Trust could be challenged. In other words, holders have a powerful incentive to protect the fixed supply at all costs, and that is precisely where a potential conflict emerges. Miners require economic incentives to secure the network. Holders require scarcity to preserve the asset's identity. Both groups are essential. Yet in a hypothetical future where incentives become strained, their interests may not align perfectly. This creates what some analysts describe as an eventual incentive dilemma. On one side are the holders who want absolute supply discipline. On the other side are the participants responsible for maintaining network security. If revenue becomes insufficient, miners may naturally support solutions that improve profitability. Holders may oppose any solution that affects scarcity. Again, this is not a prediction of collapse. It is not a forecast of failure. It is simply an observation about incentives. Systems often perform well when incentives align. Challenges emerge when incentives begin pulling participants in different directions. The reason this discussion has gained attention recently is because it highlights a question that many investors have never considered. Bitcoin's greatest strength may also introduce a long-term economic puzzle. Whether that puzzle becomes significant remains to be seen, but it is a conversation worth having. This brings us directly to XRP and why many supporters believe it avoided this challenge from the beginning. The XRP Ledger was not designed around mining rewards. Validators are not competing for newly created XRP. There is no schedule of future emissions gradually shrinking over time. Instead, validators participate because the network itself provides utility. Businesses, exchanges, payment providers, and infrastructure operators benefit from having a fast and reliable settlement layer. Their incentive comes from using the network effectively rather than earning newly minted tokens. In other words, the utility of the system becomes the reward. The network operates because participants find value in its operation, Supporters argue that this removes an entire category of long-term incentive concerns because there is no dependency on an ever-decreasing stream of newly created coins. That idea may sound simple, but it represents a fundamentally different philosophy. Bitcoin incentivized participation through monetary rewards. XRP incentivized participation through utility. One model effectively rents security through ongoing rewards. The other seeks to build security through network usefulness. Neither approach is necessarily perfect, and both have strengths and weaknesses. However, the distinction becomes more important when discussing long-term sustainability. If a network's participants rely primarily on rewards, questions eventually arise regarding the future of those rewards. If participants rely primarily on utility, the key question becomes whether the utility remains valuable. XRP supporters believe that payments, settlement, liquidity management, and asset tokenization create enduring demand. As long as those services remain useful, the network retains a reason to exist and operate efficiently. And that brings us to one of the most exciting developments in the broader blockchain industry: tokenized real-world assets. For years, stablecoins dominated the conversation because they demonstrated how real-world value could move across blockchain networks quickly and efficiently. But many experts believe stablecoins are only the beginning. Today, financial institutions are exploring tokenized bonds, tokenized treasuries, tokenized real estate, and even tokenized equities. The vision is enormous. Imagine buying a fraction of a commercial building as easily as purchasing a stock. Imagine transferring ownership of financial instruments globally within seconds instead of days. These ideas are no longer theoretical. Major institutions around the world are actively exploring them. The race to become the infrastructure layer for tokenized assets is already underway, and many blockchain networks are competing for that role. Supporters of the XRP Ledger argue that this environment plays directly into XRP's strengths. The network was built with fast settlement, low transaction costs, and tokenization capabilities in mind. Rather than focusing solely on scarcity, the XRP ecosystem has long emphasized movement of value. That distinction matters because tokenized assets require infrastructure capable of handling transactions efficiently. They require settlement systems that businesses can actually use. In this view, the future of blockchain may depend less on speculation and more on practical functionality. The networks that enable real economic activity could gain an advantage over time. Whether XRP ultimately becomes a dominant player remains uncertain, but its supporters believe the architecture positions it well for a world increasingly focused on tokenized financial products. What makes this debate so interesting is that it is really a discussion about use versus ownership. Bitcoin excels at giving people a reason to hold. XRP focuses on giving people a reason to use. Those are different objectives. Neither necessarily invalidates the other. In fact, both can coexist successfully. But when evaluating long-term network sustainability, usage becomes a critical factor. History shows that technologies often succeed because they solve real problems efficiently. The most successful companies are not always the loudest. They are often the most useful. Consumers return because the product works. Businesses adopt solutions because they improve efficiency. Utility creates resilience. That principle applies across industries, and many XRP supporters believe it applies to blockchain networks as well. Looking at market behavior today, XRP has continued attracting attention as investors watch key support levels and broader adoption trends. While price action can be volatile and unpredictable, many analysts focus on structure rather than short-term noise. They observe whether higher lows are forming, whether support zones remain intact, and whether adoption metrics continue improving. Markets rarely move in straight lines. They advance, consolidate, correct, and recover. What matters over long periods is whether the underlying thesis strengthens or weakens. For XRP supporters, the thesis revolves around utility, payments, liquidity solutions, and tokenization. For Bitcoin supporters, the thesis revolves around scarcity, security, and store of value characteristics. These narratives are different, but both continue shaping investor behavior across the crypto landscape. As we wrap up today's discussion, remember that the market is still largely focused on immediate events, price movements, and short-term catalysts. Very few people are thinking about incentive structures that may not fully reveal themselves for decades. Yet some of the most important investment questions are the ones that force us to look beyond the next cycle. Bitcoin's 21 million supply cap remains one of the most powerful innovations in financial history, but it also raises important questions about long-term incentives. XRP's design took a different path, removing mining rewards and focusing on utility from the start. Whether that ultimately proves advantageous is something only time can answer. What is clear is that these two networks approach the same challenge in dramatically different ways, and understanding those differences may help investors see the crypto landscape from an entirely new perspective. The biggest takeaway from today is not that one asset wins and another loses. It's that design choices matter. Sometimes a decision that looks controversial in the early years reveals hidden strengths much later. Sometimes a celebrated feature introduces questions that nobody notices until the system matures. The crypto industry is still young, and many of its most important lessons are still unfolding in real time. Bitcoin built a revolutionary system around scarcity. XRP built a different system around utility. As adoption grows, tokenization expands, and digital finance continues evolving, the contrast between those philosophies becomes increasingly important. The crowd may not be paying attention to these deeper questions yet, but informed investors are, and sometimes the greatest opportunities come from understanding the conversations everyone else is overlooking. Thanks for watching the Crypto Intellect. Stay curious, stay informed, keep looking beneath the headlines, and I'll see you in the next one.